Ladies and gentlemen, please welcome your panel on The Macroeconomic Outlook, a Balancing Act, moderated by Milken Institute Senior Fellow Komal Sri-Kumar.
Good morning. Thank you all for coming. And as you know, the title is Macroeconomic Outlook for the World, and we are calling it a Balancing Act. And among the 5 panelists that we have here, we are going to try a balancing act as well in terms of different parts of the world and different themes. Among those that we hope to touch on are the rise in populism in different countries and what the impact is going to be on the global economy and markets. We hope to touch on trade wars and what they are going to do. The central bank easing that suddenly seems to have taken hold, and what does it mean for the investors in terms of fixed income and equities. Finally, country ratings, again, depend very much on all the various developments, and we are going to end up with that. We are going to begin first with Christopher Smart with Barings Investment Institute, who is two to my left, followed by Brian Whalen from Trust Company of the West, Group Managing Director in Fixed Income, who is to the far left of me, going on to Nathan Sheets from PGIM Fixed Income, and then on to Seema Shah to my right. And Nathan is from PGIM Fixed Income. Seema Shah, in turn, is from Principal Global Investment Advisors. And then finishing up with James McCormack to my far right, who in turn heads Fitch Sovereign Ratings globally. So you have a good mix of people with different viewpoints. One point I would say, housekeeping, and then I'm going to stop. We are going to try to keep each speaker to just about 4 minutes. So contrary to what you may have seen elsewhere, we talk for only 25 minutes rather than listen to our own spiel. We'd like to hear you ask questions, so I hope you will use the opportunity to spend more than 50% of the time asking questions that we can answer. And I'm going to prompt some questions only if you don't begin, but ideally it'll be great if you do. Christopher, let me start with you and to try to have you give a 50,000-foot view of how you see the world.
Well, thank you, Sri. 50,000 feet in 4 minutes is a challenge that I take on with energy and expectation. First of all, I want to thank everybody for being here and choosing to be with us rather than the panels opposite us on psychedelics or American masculinity. So I would, in your position, have been tempted, but I would have done the right thing, which is what you have done, which is to think about serious economic and global issues. I think when some of us were here last year, there was a gloomy narrative going about that the United States was running out of gas, that China was a bubble, that Europe was Japan, that Japan was Japan, and that all emerging markets were some combination of Turkey, Argentina, and Venezuela. I think what we've seen since then is obviously a much better outcome to 2018, and coming into 2019, we've got some, I think, fairly optimistic news that we've seen both in the United States, where, notwithstanding a 3.2% GDP print for the first quarter, which was inflated by a couple of things. The IMF, I think, has us on a growth path this year of about 2.3%. Earnings have been coming through quite strongly. And more importantly, I think we've had some good news on both business reinvestment in itself. Capital spending is ticking up a little bit, and importantly, productivity has come in on the higher side. And I think for those of us looking out beyond this year, the productivity number, I think, is going to be key, and we've done some work on that at Barings. If you look at China, the good news there is that the policy levers work. An economy that was slowing down last year in the face of a trade war and credit restraint has responded to monetary policy and fiscal policy in a very robust way. Lots of questions about how sustainable that is over the longer term, but that's really good news for the global economy this year. And if you look to Europe, Italy has pulled out of recession in the first quarter. Germany has suffered a lot, I think, from Chinese export decline last year, and that rebound in China together with a weaker euro, I think, should give Europe a slightly better outlook. Europe is never going to look as good as the United States, for a variety of macroeconomic and systemic or demographic and structural issues. But I think the news there is slightly better than usual. I'll stop by saying the other good news is that if I'm wrong on a lot of these growth trajectories, we have central banks who are standing by, and they don't have as much ammunition as many of us would like them to have, but they do have some, and they don't face any particular inflationary pressures. Core PCE in the US, as you know, came in at a 14-year low, 14-month low just now. So I think the inflationary pressures have abated, and that leaves all the central banks with some leeway to support markets and to support growth.
Thank you, Christopher, and you did very well within your 4 minutes, so thank you for that. Brian, turning over to you to give your thoughts and anything you may think of in terms of the world debt buildup.
Sure.
And how the whole
Sure.
debt
So,
market is developing.
Cue the gloomy guy. So the fixed income guy, I'm probably going to say some things you would expect me to say, but first I'll apologize. I'm going to be probably more the micro panelist here than the macro, but let me start with some optimistic thoughts, which puts a fairly defensive-minded team at TCW willing to acknowledge that this recovery and the run in asset prices and credit spreads and all of that may go on longer than we thought. It could go on certainly for the rest of the year, maybe another year plus. And what that is, first of all, clearly the dovish pivot from the Fed in January, not just basically stopping the rising of interest rates, but also just the willingness to allow the market, not jawboning the market back from pricing in a one cut this year and one cut next year. So that's certainly, I think, been the primary cause of the recovery in asset prices. Secondly, the pausing of what had been pretty troubling global growth numbers in the second part of the fourth quarter of last year and the first half of this year. Markets are they open. Let me tell you, the liquidity, the availability to borrow, not just on the terms at which you borrow, but also on the rate and the credit spread. So it is a great time to borrow money. It wasn't so much maybe 3 months ago, but it's as good as it's been. I think the Goldman Sachs Financial Conditions Index is back to where it was in early October. So we're right back to the good times. Then maybe the last point I'll make on the optimistic side, what I think maybe just goes a little bit under the radar, has to do with FX, particularly with regards to central banks and almost like the convergence of the stance of central banks. Back in what caused a lot of volatility in the fourth quarter, it was you had the hawks, you had kind of the central banks running in place and neutral, and then you obviously had the doves continue to expand their dovish policies. Now we've got a group basically in the middle. You got neutral, and then you've got doves. And I think what we've seen that is transpire into more stable FX rates, and that's also added some stability to the globe. On the pessimistic side, we're still left with our primary concern, which is basically a global debt to growth imbalance. Too much debt, not enough growth. Given a decade of this great monetary experiment, if we've been unable globally and in the U.S. in particular to get out of this mediocre type growth environment, it's hard for us to envision the ability to kind of grow our way out of this imbalanced ratio of too much debt, 220% of global debt to GDP right now, to growth. In the U.S. in particular, when we think about credit, we're looking at about a 46% debt to EBITDA ratio on non-financial corporate debt in the U.S. Anytime that ratio has exceeded 40% over the past 35 years, within 24 months, we saw the high yield corporate default rate spike over 10%. So we saw basically a solving of that imbalance in that ratio, not through growing your way out of it, which is the denominator way, but the numerator, writing down that debt. Asset quality has deteriorated significantly. Basically, credit agreements look like Swiss cheese to us. Obviously, loan covenants, maintenance covenants are for the history books. Credit agreements with regards to restricted cash, restricted payments has been watered down. Asset stripping seems every new company every day is doing some sort of shenanigans within their corporate structure to move assets away from lenders. Let me finish with this final thought, because it's maybe a little more macro, and maybe one of my other panelists here will touch on it. And I'm not an economist, but I took a few classes back in school, and what I remember reading is that monetary policy acts with a lag, both when you're easing as well as when you're tightening. And what's concerning to us, and why we're not willing to give the all clear, is the market's full embrace that because the Fed pause back in December, everything's going to be all right. And when we look at the way credit spreads have behaved over the last 8 tightening cycles, 4 months after the last hiking, it doesn't look much different than the way it used to be, but it looks a lot different 12 and 18 months later. And I'm going to stop there and leave a little meat on the bone if you want to dig into how they actually performed.
Thank you, Brian. Nathan, if you could take it up from there, extend it further, what are we doing with respect to trade wars? What is the United States doing, and how is that going to affect the global outlook?
Well, very good. It's a pleasure to be here. And I think these issues like trade war and the Fed and so forth are crucial in shaping the global outlook for the next 12 to 18 months. And on that side, I'm probably closer to where Christopher is, in that I think we got hammered by a pretty big shock in the fourth quarter. And it seems to me that much of that shock has abated. And particularly central banks has been discussed and concerns about trade war. Now, in response to the question specifically, so my expectation is over the next few months that the United States and China will reach agreement on a trade deal. I think we have to say that, and I say this reluctantly, but I think we have to say this, that the administration's trade policies have brought the Chinese to the table in a way that has not been the case in the past. And there are legitimate issues that the United States has been talking to the Chinese about, like intellectual property and technology transfer and non-tariff barriers and level playing field for U.S. firms in China that have been open. And I think that we are likely to see some progress. These are very complicated issues. So I don't think a single deal is going to address all of them, but we're going to see a step forward in this trade deal. However, even as I say that, there are also a lot of questions. So one question is, well, how ambitious will it really be at the end of the day? And what about the administration's, in my view, misplaced emphasis on the bilateral trade balance? What are the implications of that? Does that end up being just kind of reshuffling of global exports? Or is it something more profound? And if China does buy more U.S. exports, how does it achieve it? Does it achieve it by directing the state-owned enterprises to buy more U.S. products? And does that end up increasing the size of the SOEs in the Chinese economy and running counter to our ideas and our notions of structural reform in China? And then at the 30,000, well, I guess you said 50,000 foot level, the issue of what is this policy that the U.S. has pursued? What does it mean for the global system? Will there be more protectionism, more tariffs going forward? And what about U.S. leadership? So when I think about the global outlook, I think, as Christopher articulated, I think that a lot of these shocks have abated. Leaves me pretty optimistic for the next 12 to 18 months. And I think it's going to be a fairly favorable environment for financial markets with solid, not spectacular, but solid global growth, low inflation, and central banks on the sidelines. But then as I pivot beyond that 12 to 18-month horizon, I'd echo some of Brian's concerns about debt and demographics. And the key question in my mind that hovers over all of this is the issue of where is productivity headed in the United States and in the rest of the world. On the one hand, it feels like we're awash in productivity, but on the other hand, we just aren't seeing it in the data. When are we going to see productivity in the macro data? That's probably the biggest long-term issue that we have, and on that, the jury's still very much out.
Thank you, Nathan. Overall, quite a positive view. So hopefully, for now, and hopefully there'll be people who would disagree in terms of making the debate going. Seema, turning over to you, and again, we have talked a little bit on how China fits in. If you could go in further in terms of what's happening to the Chinese economy, what's happening with the stimulus, what it's going to do to the rest of the world.
Sure, thank you very much. So my general view is that this global recovery that we've had in place, will be extended into the second half of the year. And really, China is at the forefront of that story. So there's been about 75 to 80 different stimulus measures in China since last June. They will have an impact. We're already starting to see that fruition. Now, in recent weeks, admittedly, there has been some concern, especially in markets, that these authorities are pulling back from some of those stimulus measures. But that is really down to the success so far of their stimulus. So the way I'd consider it is it's not really putting their foot on the brake, it's taking their foot off the accelerator. The other thing that I would also point to is a country like China, they have a 70-year anniversary of the formation of the People's Republic of China coming up. They are very unlikely to allow a double slowdown coming into play. So I think that's going to be a key point going forward. For the rest of the global economy, they are pretty much teetering on China's shoulders. So if you think about Europe, I actually have a relatively positive view on Europe for the second half of the year, but that is because it's being driven by China. If you look at the internal dynamics within Europe, it's not very impressive. The intra-European trade has been disappointing. We have admittedly had some fiscal stimulus coming from Germany for the first time in many, many years. And you have got some wage growth. But that is not enough to counteract that weakening EU demand. The ECB has been quite supportive, but at this stage, I think there's not much that the ECB can do to provide stimulus. Providing forward guidance is good, of course. Liquidity operations later this year is positive, and certainly some tiered deposit rate schemes potentially later in the year is good, but all it's doing is stopping the rot from kind of spreading. So the best I think we can expect from the ECB is that they make all the right noises and they don't make the wrong move. So turning to the US, I have a similar view. I mean, there is some weak dynamics coming through. We have the sugar high from tax cuts last year starting to fade out. We have the lagged impacts from previous rate hikes. It takes about 18 months for them to feed through to the economy. So those are all downward impacts, and that's being then counteracted again by the lift in China pushing up global growth, and you should see multinational earnings starting to pick up, I think. The more important question, I think, for all of this is what if all of that goes wrong? So what if the trade story doesn't work out? What if China's stimulus starts to fade out again for some reason? For this, I think, you look at the ECB, I mean, I've already said there's not much that they can do. The Fed, on the other hand, can cut rates. But I would point to this. Historically, every time the Fed has cut rates, it started to cut rates, equities have performed badly because it's signaling weaker economy ahead. It's very unlike the pause in rates, which means that the economy is going to be supported. Now, this is going to be a really important environment right now because what we've seen is that market anxiety at this stage of the cycle is really feeding back into the economy. And that's something that the Fed will need to be very cognizant of. In the last few quarters, you've seen market sentiment very much fluctuate very sharply over exuberance, over pessimism, and back, and so forth. And in anything, the echo chamber for market anxiety has rarely ever been greater than this. So I think the Fed will be very concerned if they do need to move to a rate cut to make sure that market anxiety doesn't feed through and trigger a self-fulfilling market meltdown of the type that we saw in December. So in conclusion, it's, for me, yes, there are many things going well for the global economy. And as important as it is for the Chinese economy to have a soft landing, it's also very important for the Fed to get the correct landing too.
Thank you, Seema. James, from your Hong Kong base, you have looked closely at China. You've seen the transformation taking place, moving toward a consumer economy. You've watched the current account surplus slowly disappearing. How do you see China, and where does it fit in the global rating scheme for Fitch?
Yeah, I mean, China's come up a couple of times, so I'll try to stay away from what's been said already, all of which I would agree with. I think those two changes that you mentioned are worth just pausing and thinking about for a second, because they're important for the growth outlook and the growth drivers. They're important for the policy response and the kinds of stimulus that you might see, and they're important for the global spillovers from China. So if you think about China moving from an investment-led growth model to a consumption-led growth model, that's already happened. So 3/4 of the contribution to growth last year on the demand side was from consumption, which might take a lot of people by surprise, but China is now a consumption-led growth story on the demand side. And it's interesting because if you kind of dig around the numbers a little bit, you would see that retail sales numbers started to fade a little bit last year. I think we all know about the auto story, so auto sales coming down, which tells you that actually that a lot of that consumption isn't goods, it's services. So there's another part of the transformation that's going on in China is towards a more service-oriented economy, consistent with the emergence of a middle class, and I'll come back to that in a second. So if you have a consumption-led growth story, then it changes the kinds of policy stimulus that the authorities would be thinking about and the kinds that they've rolled out. We've heard how a lot of policy stimulus over the last year, and I don't think they're quite done yet. But it does change the kind of stimulus that will be effective in a consumption-led growth story. It's no longer stimulus by sort of directive. It's really stimulus more by sort of incentives. So cutting tax rates, cutting the personal income tax rate, which really wasn't a factor ever in previous stimulus rounds in China, cutting the value-added tax, not the corporate income tax, but the VAT, because that's going to help companies that aren't very profitable, that aren't paying corporate income tax anyway. And so this kind of stimulus is quite different than the previous kinds of stimulus, in that you don't always know if it's going to work. When you put incentives and tax cuts in place, you don't know if there's going to be a response from the demand side. When it was investment-led growth, and the government could sort of pick up the phone and speak to the banks and encourage them to lend to stimulate investment, that was much more direct and effective. So I think that has changed. If it's a consumption-led growth story, it also changes the dynamics of how commodity-intensive growth would be in China. It would be less commodity-intensive. So the spillovers internationally may be less or different than they had been previously. The second change that you mentioned, this current account surplus turning into a current account deficit, it'll either happen this year or next year, depending on when you forecast it. We think it's this year. And it's not really it's not the trade balance that's really changing, it's the services balance. So the trade surplus is definitely getting a little bit smaller, not necessarily on the manufacturing side. That's commodity imports actually are still quite strong. So the manufacturing surplus is still there. China's competitive. But the services deficit is growing quite large. And this is really Chinese tourists. This is a Chinese service imports, essentially, Chinese leaving the country and spending money outside of the country. So that's an important development, because when we think about the global role that China has played in terms of capital flows, the years of current account surpluses and the Asia savings glut and the Chinese buying a lot of U.S. Treasury securities, those years are definitively over. So China is going to be a net importer of capital going forward because it's running a current account deficit going forward. So going to be competing with other emerging markets for capital imports. Not large at the outset, and gross flows will still be big. So there'll be still gross inflows and gross outflows, but on a net basis, China is an importer of capital. And I think that's an important thing to think about from a global perspective. I'll leave it there.
Thank you, James. Now you have a variety of topics to ask your questions on, and you can either pose your question to a specific speaker, or many of the speakers may want to respond. The gentleman in the fourth row, please, sir. Is there a microphone in the room? No, but go ahead, please.
Thank you very much. I learned a lot from your presentation. And I'd like to ask a question to summarize your presentation. I'd like to ask each panelist to point out only one positive risk factor and also only one black swan or tail risk in the global economy.
Great questions. Who'd like to begin first? The risk factors and the black swan, both of them.
Positive sometimes.
Positive as well.
Only one.
Okay.
Okay.
Yep, sure. I think if I think about one big risk factor that we didn't really talk about very much, I think European politics is still in play. Maybe we'll talk about populism later, but if you look around the big Western European countries, Italy, France, UK, Germany now with a political transition, so we have a chancellor who's not really a political leader, but a head of state. It's kind of weird. So I think there's political risks and political factors at play in Europe. which could affect the economic outlook. We've heard that it could be coming back. For me, the potential good news story is the U.S. economy being stronger than people think.
Anyone else? Christopher?
I would just add, just to go back to what I think we've mentioned before, but productivity, I think, is the big potential upside surprise, which we have not seen over the last several years. But again, the recent data is much better. And I think there's a lot of reason to believe that the way companies are transforming their business models to take advantage of the Internet of Things, cheap sensors, distributed mobile networks, an ability to store lots of data in the cloud and then analyze it in real time is providing tremendous potential for operating profit improvements across a series of industries, whether it's mining or manufacturing or others. And I think that's a very important space to watch. And that will drive growth, I think, in excess of what we've been expecting given current demographic trends. My sort of black swan event has more to do with places like China, which are, I think, over the last several years been increasingly important as a global trading partner. But over the next several years will be an increasingly important financial partner. And any kind of disruptions on the Chinese market, domestic market, will not stay in China. They will ripple through to the global economy. I think that's an important space to watch.
Thank you, Christopher. Nathan?
So I very much agree that the upside risks for the global economy seem to be primarily emanating from the United States, and that the U.S. outlook may be somewhat stronger than it's traditionally thought, as headwinds from the financial crisis that have plagued this economy for so long finally abate. It's a little bit of the Reinhart-Rogoff story that following financial crises, there's roughly a decade of slow performance, and then the economy goes back to the previous potential growth rate. And that would be, if we move in that direction, let alone re-achieve that potential growth rate, that would be an upside surprise. On the downside, I'd say one risk that I'm worried about is a debt ceiling standoff in the second half of the year. That could be very disruptive for markets and the economy. And the other one is a little more subtle, but I'll call it fear of longevity. So in July, this becomes the longest lived expansion in U.S. post-war history. And I think that there are some folks in the economy and the markets that are kind of looking at the calendar and saying, well, it's now over 10 years. This thing must be late cycle. And it's making them a little bit more jittery. Whereas an economist, when I look at where we are in the United States and globally, I certainly don't see the same imbalances that I saw in 2006 or 7. But it doesn't necessarily feel like a recession or a market meltdown is around the corner.
Thank you, Nathan. Seema, I'll attach something to the gentleman's question from the floor, which is you talked about Chinese not allowing a double slowdown. But you again have a near black swan in the summer of 2015 when the equity markets and the currency both collapsed within 3 months from June to August. Could it be much worse with the debt levels only much higher than they were in 2015?
I think that's certainly a risk, and you could see that with their deleveraging campaign that it was a concern. And although the short-term outlook for China is positive, given that they have started to, they have in the last year or so introduced all these stimulus measures, I think it's almost a medium-term horizon for China as they try and move from this kind of low-income to middle-income economy that there's so many potential obstacles on the way. But I would say that for me, the main risk would be actually, and this is slightly odd in a way, but it's actually the positive risk would be if the US economy can just maintain solid growth, not very strong and not very weak. So it's continuation of that Goldilocks. And the main reason is that I don't think the US economy can deal with higher interest rates. And that's mainly because of the increase of zombie companies, kind of corporate debt being so high. So actually need something very, very stable. And that returns to your productivity point. And the black swan for me is actually a strong dollar, because emerging markets cannot deal with a stronger dollar. We're riding on the hope that there's a weaker dollar this year.
Thank you, Seema. Go ahead,
Maybe
Brian.
on the upside, I'll start with the U.S. consumer. As a pessimist, but I have to, when we look at the data, really the only headwind to the consumer has to do with student debt, not necessarily what's going to happen with that debt and how they're going to behave on that debt, but the headwind, broadly speaking, to what the millennial generation and how they're going to spend their money, or can they spend their money on cars and homes and things like that. But outside of that, the U.S. consumer looks particularly strong. Anything you read about credit card delinquencies or auto delinquencies, you got to remember, while they may be ticking up, they're coming up from very, very low levels. Mm-hmm. So on the whole, the U.S. consumer looks strong, and that should provide a tailwind to the U.S. economy and then to the globe. My black swan concern, or what I'll mention here, it's not so much economic as is market oriented, but I don't think people realize that how imbalanced the public fund market is. We kind of think of it as like an asset liability mismatch in the system. Basically, there's too many daily liquidity funds out there promising their clients high yields that they're starving for and going after risky debt and risky assets. And they're making these promises that I guarantee you, in an environment like the fourth quarter, they cannot keep. They will be unable to redeem their clients who think they have daily liquidity funds. That is my concern. It's not the shadow banking in the system like it was 11 years ago. It's this public fund space and kind of a run on the funds. That's the concern, and I think that could have major ramifications for asset prices.
Thank you, Brian. I thought there was a question in front. Sir, please go ahead. There's a microphone coming to you.
Thank you so much. My question's a little bit more narrow. In October, when the ECB retires Mario Draghi, who do you think takes his place? And do you think it even matters at this point, given the limited toolkit that the ECB really has?
I'm assuming that's directed to me.
It was.
I think it's extremely important. Actually, it's one of the factors that is wholly underappreciated by markets. What we've seen over the last however many years that Draghi's been there, he has been the most market-friendly central banker that Europe could have hoped for. Very, very dovish. If it wasn't for Draghi, I don't think QE ever would have taken place in Europe. Now, as we move into a cycle where there is likely to be a downturn at some point in the next few years, how they navigate that is so dependent on how that central bank is going to be acting. The chances are that given in academia, QE is generally criticized, and specifically in Europe, it's very much criticized. QE, I think, is unlikely to ever happen again in Europe. You're more likely to have a more hawkish central banker who looks to actually unravel that balance sheet expansion. So that means balance sheet reduction, very negative impact on the global economy. And the other thing that I would point to is, a lot of people talk about in Europe, we need to have this flood of fiscal gates happening. Fiscal expansion in Europe, it is happening very slowly, but it's not happening at the pace that they need it, and I think it's still at least a decade away before that happens.
Well, let me go further to the gentleman's question for anybody here. We started out with a Dutchman as the ECB president. We moved lower down the scale in terms of profligacy expansion with the Frenchman. We have really gone to Southern Europe now for the last 8 years. Isn't it Germany's turn?
It's interesting. Well, with Europe, I guess with a lot of these large organizations, they take their turns. They rotate which country, which region is allowed to be kind of the head of the IMF, the head of the European Commission. Within Europe, there'll be decisions between the ECB, the European Commission. I think it's the European Financial Institute. So at this stage, it doesn't look like a German is going to be head of the ECB. However, there are a multitude of other very, very hawkish Northern European central bankers waiting on the sidelines.
Thank you. Nathan?
I think one framing thought in this discussion is as a result of the ongoing back and forth in Europe regarding Brexit, I think that the French are increasingly of the mind that they want to have somebody in the European Commission, someone that they feel is going to strongly affirm what they see as European values. So I think it is less likely to be someone from France or Southern Europe, and more likely to be someone from Northern Europe. In your question, is it a German? Maybe. My feeling is the Germans recognize that having a German running the ECB could be very divisive for Europe, and they're more likely to pivot to a Finnish candidate like Jyrki Liikanen.
Good point. Thank you.
I
Christopher?
was just going to follow on Sri's geographical progression and say really, it's really Cyprus's turn. But my experience in government is that the personalities are important but not decisive. And really where you stand is where you sit. And in spite of whatever you may have written throughout your career or whatever speeches you may have given, whoever sits in that chair is going to have to deal with a Europe that is growing very slowly, with a fiscal policy that, as we've pointed out, is too tight. And they aren't only going to have a certain number of tools available to them, and much as they may not like it, I think they will be very limited, and they will be forced to reconsider extending all these tools through a slower growth period, whoever the person is. And maybe to Nathan's point, the recoiling within Germany of a German being forced to do that will be an interesting spectacle for outsiders to watch. But I think the ECB will continue probably more or less on the same trend regardless of who takes that seat.
Thank you, Christopher. Any questions more from the floor? There's a gentleman at the back, and then next you, sir, afterward.
Hi. So last year, someone made a comment that if you had painted rainbows on the walls here of the Beverly Hilton, no one would have noticed. That it was so positive here last year. And while I wouldn't say it's negative from what I've heard before, that it's much more, the outlook is much more modest this year. And last year, when we were here, the market was, we were recovering a little bit, but we had just gone through February, it was terrible. Now we're back to an all-time high. So can you, and the longevity thing was something you could have said last year, and the liquidity mismatch was something you could have said last year. In fact, we went through December with liquidity match, and we came out pretty good. So can you answer why there is this disconnect? Last year, the public markets looked terrible. People very optimistic this year. Public markets good. People are modest.
Ryan?
I'll jump on that first. First of all, you should come to our office downtown. It's just dark clouds and lightning bolts all over the place. Let me say this: the volatility we saw, not just in the fourth quarter last year, but kind of the August right into September. Remember when like GE and Ford spreads were blown out, north of 300 over. Something happened in the fourth. There was the first time in years that the capital markets didn't look like Teflon. Basically, that, think about it. Were Ford and GE's business model, where they picture-perfect, rock-solid businesses coming into 2018? No. The problems that those companies had were well known, but their spreads were incredibly tight. And all of a sudden, the market psychology, and I think a lot of it had to do with the rise in U.S. interest rates and the shrinking of the balance sheet and all that, and everything going on with monetary policy, the capital markets cracked. And all of a sudden, for the first time in literally years, I'd sit at my desk and I'd look at certain, not all, but I'd look at certain borrowers, certain segments in the market, and all of a sudden, really since the oil volatility in late 2015, the market started to assume the worst on some of these credits and to start to price it like that, like high yield credits when they were IG, not assuming the best like they had for years. And I think that cracked the psychology a little bit, and maybe while you got that feel of a more tempered environment here at the conference.
I mean, I would also say that, I feel like one of the reasons that you still have that caution kind of under the surface in both credit and equity markets is this feeling that, look, the global economy isn't that strong. For you to have record highs in the equity markets when you actually have an underlying economy which is, it's slowing, it's definitely not near the highs that it was in 2017, almost doesn't make much sense. And also this absolute reliance on the Fed and other central banks to pull you out of whatever problems there are, it means that Goldilocks simply cannot last forever. So people are waiting for that new correction to happen. Maybe once that correction happens, they'll be willing to jump back in, but they need to see that happen first.
Thank you. Go ahead, Nathan.
And I think a good chunk of the pessimism that we're hearing in the sessions is structural and over the medium to long term. And what tends to happen is when the near term's okay, then people cast their eyes out further. And when you look out further, there is a lot to worry about. We've emphasized already the debt and the demographics and the populism. But the theme of the whole conference is driving shared prosperity. What about inequality? How do we address all of these challenges that face us over the medium to long run in a way that preserves our institutions and allows the U.S. economy and the global economy to continue to grow. But we're setting a higher standard for ourselves, which is appropriate. Not only grow, but grow in a way that's fair and equitable. And that's an overwhelming challenge for us, and I think we don't have the answer. We're all thinking it through together, and I think we will be for quite some time. But I think some of the pessimism is more kind of long-term about how we deal with the structural issues, and I think we have that leeway given the near-term outlook looks a little better.
Thank you, Nathan. There was a gentleman, I think in the second row. Yeah, right here.
Thank you. Can I double down on a two-part question? First, for our fixed income and sovereign rating experts, can we compare and contrast non-investment grade credits with EM debt and look at the relative attractiveness of those two markets? I'd be curious to hear that. And for Seema, curious again on Brexit, what do you think the outcome is there and how that might affect risk appetite?
You want to?
Go ahead, Brian.
All right, so EM, it's a lot of different stories, a lot of different names. Generally speaking, it's not as fundamental a concern from the EM perspective as from a more of an IG or more, we'll say, at a high yield debt perspective. So when we're building our portfolios, a lot of the EM credits look more bendable than breakable, meaning that the investments in the EM, we're not thinking of them right now as investments where you're concerned about loss of principal. You should be concerned about mark-to-market risk, though, because when the breakable goes, and that's when we talk about corporate debt, high-yield debt, 6 times debt to EBITDA, like I said, Swiss cheese credit agreements, recovery values less than 20 cents on the dollar. When that breaks, and eventually it will, we all get paid to nail the timing, but when that breaks, it's certainly the bendable credits in EM will have a mark-to-market volatility, but I'm more concerned about losing my dollar on the corporate bond side than I am about the emerging market side.
James?
Yeah, it's interesting because when I talk to my colleagues on the corporate team, especially here, it's all about the triple B world and what's going to happen to the triple B world and how many credits are going to be migrating lower. In sovereign world, that's already happened, actually. So the migration from triple B to double B was sort of 2015, 2016 story. It was Brazil, Turkey, South Africa. The big emerging market borrowers have already been downgraded. So when we look sort of at emerging market ratings today, you have to look at it by region, actually, and there are some clear regional patterns. In emerging Asia, there's really nothing going on with the ratings, at least from our perspective. It's the most stable region, has been probably for 15 years. So in terms of the outlooks, positive and negative, right now we have none. Doesn't mean there aren't credit issues. There's Pakistan, there's Sri Lanka, in South Asia there are some stress stories, but for now it's the most stable region. The most positive region has been in emerging Europe, largely off of the growth that we have seen in the last couple of years in Western Europe. So maybe that's coming off a little bit, and so some of that upward momentum that we've seen in terms of ratings, whether it's Croatia or Bulgaria and Romania and Poland and Hungary, those stories have been quite good, but maybe that's kind of run its course. And then we're left with the two regions that are really facing the most stress right now and have been for the last couple of years. Middle East and Africa, where the debt levels, particularly in sub-Saharan Africa, have run up a lot. The dollar-denominated debt, and I would agree with Seema that it's all about the dollar when you're thinking about emerging markets. And if you have one single variable to follow in thinking about emerging market credit, it's the dollar. We've got a chart that shows the relationship between the dollar and our average emerging market sovereign rating, and it's been correlated since the beginning of time. So I think sub-Saharan Africa is a region to think about in that context, and the other region that is kind of struggling from a rating perspective is really Latin America, where we see continued downward pressure in a number of countries. Argentina being the most obvious right now, but Venezuela, we've got a default rating on it, so there's not much to really talk about there. But we've got a negative outlook on Mexico, so it's the big ones in Latin America that are struggling to some degree.
Thank you, James. Seema, the question for you on Brexit.
It's interesting. There's always past presidents, prime ministers at Milken, and it's rather telling that David Cameron is not here. probably a good thing. You know, I just listened to Peter Mandelson, Lord Mandelson, talk just before this session about his outlook for Brexit, and I think he spoke for most Brits out there that absolutely nobody knows, and it's been an experiment in how broken down British politics can get. The investment climate is negative in the UK, not only because the prospects of a hard Brexit, but also because it's been extended, and that uncertainty is really weighing on the UK economy. It's seen, I mean, even just in the last last month, when you saw that Article 50 date be pushed further out to October, you've seen even more businesses actually decide just to, forget this. We don't know how long this is going to go on for. We're going to relocate. From an actual capital market perspective, what we're tending to see is, there is no movement. Sterling is still hovering about 129, 130, even as you have this repeated question of, is there going to be a hard Brexit? Is Theresa May going to step down? What's going to happen? I think the main reason is because we don't know what's going to happen, and because the two potential results are so binary, you cannot trade it. You cannot. If you take out your positions, you're really risking out on potentially the best trade of your life, because British banks could see a massive surge if there is a Remain, if Article 50 is revoked. And on the other hand, if you're going to go into UK assets, of course you're risking a big drop if there is a hard Brexit. So I think that's what it is. Sterling is not pricing in a hard Brexit. I'm repeatedly asked that. It is not. If it was pricing in a hard Brexit, you'd see it closer to parity with the dollar.
Great, thank you. Christopher, did you
Well, I just wanted to add, in some ways, the near term is very hard to predict, and it's very difficult to know how it will come out. But in other ways, from my point of view, the markets are sort of telling us that the decision has already been made. Britain has left. It doesn't really matter even if there is a change of heart. The EU partners can't really trust that Britain isn't going to go through another referendum in 2 years or 5 years, that it isn't going to be called into question yet again. And so even if Britain is formally still a member of the European Union, it's essentially lost, unfortunately for many of us, I think, it has lost its voice in shaping the kind of place the European Union is. And whereas we always counted on the UK's voice to edge towards market solutions, particularly in terms of financial markets, I think that voice is either not going to be there or substantially weakened. And we need to look at Europe as a region that is driven by Germany and France for the most part. And those are more statist impulses, less market-friendly impulses. You see that sort of in competition policy, talking about creating European champions or national champions rather than allowing competition. And I think much more difficult to negotiate trade agreements with the new Europe. So it pains me to say that, but I think the story is almost in many ways over, and Britain has left.
Sorry, I just want to add to that, because I think Christopher, you did bring a really good point up. With Brexit, whatever happens this year, whether it leaves or it doesn't leave, this question is not finished. This is going to keep coming back to Parliament every single time there is an election, because it has completely broken British society. So that uncertainty for the UK economy is now going to be a continuous state until we either get one way or the other, and even then they'll always be talking about revoking a hard Brexit, maybe returning into the EU or the other way around.
Let me pose one to both of you that you talked about Brexit. The Conservative Party lost the youth. The youth wanted overwhelmingly to remain. The old people wanted to exit. That is the demographics of the June 2016 vote. Now, are we looking at not only the Theresa May government falling, but are you looking at Prime Minister Jeremy Corbyn? And is that incorporated in the pound exchange rate?
Well, that's probably not incorporated in the pound exchange rate, I would venture to say. I think it's maybe more complicated than the old people versus young people. I think it's very much a haves versus have-nots. It's people who feel like the system is rigged and not working for them. And the merits of EU membership be damned. We don't like what the folks in Westminster have done for us over the last 2 decades, and we want something new. How that sorts out in a referendum or a new election, I think, is very, very difficult to predict.
The Jeremy Corbyn issue, I don't think is priced in whatsoever. Jeremy Corbyn is, he is very, very leftist. He's socialist. He's tweeted many things about raising taxes on the banking system. He actually tweeted once that if, I'm trying to remember what it was, but it was something along the lines of, banks are right to be scared of me. Okay, so, you know, if Jeremy Corbyn starts to be priced into the market, you're going to see big, big moves. With the youth, the interesting fact on that is there was a point last year, I think in June, when you look at the demographics and the way that the referendum results came through. There was a point in June when if you look at, you know, how many people must have passed away from that age group and people who had joined the voting age, if the referendum had taken place last year, you would have a very different result.
We should hope that Jeremy Corbyn is invited to Milken next year.
But in terms of the topics that we didn't touch on, Brian, you talked about the dovish pivot by the Fed, and Christopher, you followed up with all the central banks standing by to ease further. Inflation is not picking up. Inflation is low worldwide. If anything, the more you expand, monetary expansion takes place, the further the prices fall, or the inflation falls. What does that mean for a medium-term global outlook? Are you stimulating the markets only to just pull it down in a vigorous way? And this goes back again to the black swan issue.
Maybe I'll just start with a question. I'm asking myself, which is the Fed going to get inflation up? Is the Fed going to step back on the gas again to get an extra? Where did the core come in? Like 1.6 on PCE. Is the Fed going to step on the gas again to add another 0.2 to 0.4 to the inflation, or to try to get that up, and willing to sacrifice continued excesses in the capital markets? I think that's a debate that I would assume they're having right now. You know, is it worth it? Trade off those pros and cons.
Okay, Nathan.
I think this is the key analytical issue for central banks globally. You have these central banks who are driving their monetary policies off inflation targets. And more it's clear that they don't understand the inflation processes in their own countries. If I'm a central bank 15 years ago, we would have said with great confidence, the one thing we can do is create inflation. And now when we look back over the experience over the last 15 years, the central banks are much more humble. Does a tight labor market create inflation? Well, look at Japan, where the unemployment rate is around 2.5%. It doesn't seem like it really does. In the United States, we have a tight labor market, and wages have gradually picked up a bit, but it's not really yet passing through into core consumer prices. And in fact, we've recently seen a retreat in those indicators. It really boils down to inflation is equal to inflation expectations. And the economics profession doesn't know a whole lot about what drives inflation expectations. It puts us as participants in global markets and the global economy, puts us in a very vulnerable place when the central banks don't know how to achieve what they feel is their key reason for being. And it's a challenge going forward that's manifesting itself in different ways with the Fed, the ECB, the BOJ, and elsewhere.
Thank you. But James, is the global monetary easing a tide that lifts all emerging market boats? Even Argentina would be worse today if the Fed were hiking interest rates rather than cutting. So is it good for overall and sovereign ratings get increased as a result?
Yeah, Argentina would be worse off. Yeah, there's no question about that. But just coming back to some of the things, it's interesting that one of the things we haven't really talked about, and the sessions that I've been to, nobody else has talked about it either, is this debate about modern monetary theory and central bank independence, because I think this is also where we may be going, right? In the sense that it seems that it's no coincidence that debate and that discussion seems to happen a lot in countries that have high levels of government debt. And that, there's only a couple of ways you can get out of a debt problem. You can grow your way out of a debt problem, which in many countries doesn't look doesn't really look likely with the relatively low productivity rates we've been talking about and low potential growth rates. You can have a big fiscal adjustment, which doesn't really seem likely either in this country or in any of the Western European countries. Fiscal stimulus, maybe a couple of years away, but that's taking us in the other direction. Or you can inflate it away, right? That's a tried and true sort of method of bringing down real debt burden. So I guess, that is something that I think maybe the debate here in the U.S., which I look at from far away, is not really the one that we will end up sort of having and develop into something meaningful. But I think there are certain threats to central bank independence, not just here, but in a number of different countries. And I think there's the thread of a story there, and I suspect we'll be discussing that at future Milken events, definitely.
Thank you, James. Very quickly, and then one more topic before we have finished.
Sure. Just so very quickly, I think one of the things is, and this I guess is a black swan thing, is there's a great assumption that there's deflationary trends globally, and I certainly that's the case currently. If you look further out, I think there is a risk that inflation does return, and that's one of the reasons why central banks have been somewhat reluctant to raise inflation targets, etc. And that is, yes, technology is continuing to have a deflationary impact, but globalization is actually going back into reverse now. So that globalization, which was pushing down inflation, is now stopping. It can't go on forever. You can't have a continuous increase in the global workforce. And you're having countries like in China, across emerging markets, where wage growth is starting to rise. And at that point, you could see inflation coming back.
Thank you. Nathan, you mentioned US and China likely reaching an agreement very soon. Now, even if they do, and even within the US government, you have a dovish camp and a hawkish camp with two different groups. And we don't know what President Trump would do. You may have an agreement and he may walk away from it. Why feel optimistic on that ground? Because it's so important to the global economy.
So my sense is that the president wants a victory that he can point to for the 2020 elections. So if he walks away from the agreement and says, oh, it was not a success, he's got a more complicated narrative in 2020. Now, could he, if reelected, do that in 2021 to put more heat again on the Chinese government? Absolutely. And it wouldn't at all surprise me if the second Trump administration came back and pressed China for more progress. It also wouldn't surprise me if at some point a Trump administration or some other administration decided to move forward with tariffs on European autos to try to open up that market. And in addition, I think he would love to have a conversation with his European counterparts where they say, Mr. President, please remove those auto tariffs. And he says, sure, I'll see what I can do, but it would be great if you could do something for me on agriculture. And then you open up a really divisive can of worms in Europe. So this trade war, the trade dispute, these trade tools, I think are going to evolve in a number of different, could evolve in a number of different ways going forward. But I think President Trump, by the same token, wants some victories to point to
before
for 2020.
Thank you. Christopher, were you going to
add something? You open up a can of worms on agriculture in Europe, but also in Iowa, if you start talking about agriculture in the trade context. But I think the broader point you make is exactly right. This particular deal, I think a lot of people believe it will happen soon, but almost everybody believes it doesn't really matter. We're going to be in a constant, continuous argument with China about the way it treats our companies, about the way it treats its own companies, about how it does or does not observe global rules, and the fact that tariffs may or may not be taken down with this particular agreement doesn't particularly matter either, because they will always be there to be slapped back on, and anybody planning to do business, planning to make an investment with an eye to exporting to China or importing from China has to price the potential of tariffs into that business model. So I think we're going to be living this a long time, and particularly as we go into a presidential election campaign, there are at least 20 Democrats who are ready to bash China, perhaps as eagerly as the president is in the best of times. So
thank you, Christopher, and thank you all very much for being not only such eager listeners, but posing all your questions. I hope you found the session useful, and once again, have a great day. Thank you.
Thank you.